You won't believe the heated battle raging in the world of US stocks right now. It's a relentless battle between the hopeful and the skeptical, each with divergent views. Some are sounding the alarm bells, predicting a looming crash, while others remain steadfast in their belief that the current rally will endure. Bulls like Jeremy Siegel insist there's still room for the stock market rally of 2023 to flourish, while bears led by legendary Michael Burry forewarn of an impending storm. The clash between these two sides is intensifying, and there's more to this story. Stay tuned till the end as we dive deep into the forecasts of market experts in this epic bull versus bear showdown. It's going to be one heck of a ride. Let's start with Jeremy Siegel, a Wharton professor. So here's the deal. Jeremy Siegel, the retired Wharton professor and author of the famous book Stocks for the Long Run, is the real deal when it comes to stock market expertise. This guy has spent years soaking up knowledge and gaining hands-on experience in the field, making him a highly respected authority on all things stocks. But what sets him apart is that he's not just some academic stuck in the ivory tower. No way. He's got a knack for reading market trends like a pro and making predictions that often turn out to be spot on. Now, here's the juicy part. Siegel is known for being a bit of a rebel when it comes to market forecasts. He's got this contrarian perspective, always going against the flow and challenging the popular opinion. And guess what? That's exactly what makes him so darn good at what he does. His willingness to swim against the current enables him to make bold predictions that often prove everyone else wrong. In today's market landscape, Siegel remains a true optimist. He finally believes that stocks are going to keep on climbing as inflation starts to cool down. And get this, he even thinks that this could prompt the Federal Reserve to put a pause on interest rate hikes, or maybe even lower them. And you know what that means, right? It's like a rocket fuel for equities. What makes Siegel stand out even more is his unwavering confidence in his own forecast. And now, Siegel's projections for the S&P 500 are equally bold. He's suggesting that we could see a whopping 20% surge within the first 6 months of 2023. And that's not all. He's also throwing a prediction that by the end of the year, we could be looking at a gain ranging from 15 to 20%. We've also got some bullish vibes coming from Wall Street. Tom Lee, head of research at Fundstrat and one of the biggest optimists around, is boldly predicting that stocks could reach record highs by the end of the year. According to him, investors have already factored in a ton of negative news, particularly concerning weak earnings growth. Now here's the real kicker, Lee explains. There are those who say earnings are the next shoe to drop, but EPS estimates have been falling for many months already. EPS stands for earnings per share, and he's basically saying that the expectations for earnings have been dwindling for quite some time now. But here's what really matters. According to Lee, how are stocks reacting to EPS results? And guess what? Investors seem to be taking missed earnings reports in stride. Lee points out investors are punishing misses to a far less extent, highlighting a lot of the bad news of 2023 EPS is getting priced in. In simpler terms, while falling earnings aren't necessarily a good thing, it seems like a significant portion of the negative impact has already been factored into stock prices. So, what's Lee's bold predictions for the S&P 500? He expects the index to soar another 18% this year, hitting a mind-boggling 4,800. That's a whole lot of optimism right there. At this point, you should pay more attention because we've got some contrasting views on the stock market. First, we've got a warning coming from the legendary investor Jeremy Grantham, the co-founder of GMO. He's warning investors of an impending stomach-turning 50% decline in US stocks, even after last year's 20% dip. According to him, equity valuations are still outrageously high. Grantham explains, "My calculations of trendline value of the S&P 500 is about 3,200 by the end of 2023. Basically, he's saying that the index is significantly overpriced and due for a substantial correction. But here's the bigger picture. Grantham believes that long-term issues like declining population, scarcity of raw materials, and the damaging impact of climate change are starting to seriously hinder growth prospects. And just when you thought it couldn't get any scarier, Grantham raises concerns about the interest rate environment and the global property markets. He warns, over the next few years, the possibility of a downturn in global property markets poses frightening risks to the economy. So if it seems like Grantham is waving a red flag and urging investors to tread cautiously, with his expertise and track record, his words carry weight. So keep an eye out for any shifts in the interest rate environment and global property markets, as they could be key indicators of potential risks ahead. Before we delve into Michael Berry's intriguing outlook, let's take a look at another bearish forecast. David Rosenberg, founder and president of Rosenberg Research, believes there is still more room for stocks to fall. According to Rosenberg, the moment he stops being asked, "Are we there yet?" is when he knows we haven't hit rock bottom. He describes the recent bounce back in stocks as bumpy and uncertain bear market rally. In his view, stocks remain significantly overvalued compared to other assets, leaving little reason for optimism. As the US economy faces a slowdown and the central bank persists with rate hikes, Rosenberg warns that stocks are exposed to further declines. He suggests that the S&P 500 could drop as much as 27% from its current level of around 4,100 points to as low as 3,000 points, if the Federal Reserve remains steadfast in its pursuit of a 2% inflation target. Now, let's turn our attention to the legendary Michael Berry, the man who accurately predicted the housing market crash in 2008. Berry consistently expresses bearish sentiments about the stock market, cautioning against potential crashes and dismissing market rallies as short-lived. Drawing a striking parallel, he compares the current S&P 500 rebound to the infamous dot-com bubble, hinting at the possibility of a catastrophic outcome. Berry's skepticism stems from his belief that recessions often see temporary market upswings. He previously warned that the S&P 500 could plummet by over 50%, sinking below 1,900 points. In a recent tweet, he delivered a concise but powerful message to investors: sell. With these contrasting viewpoints, what's your take on the future of the stock market? Let us know in the comments. Thanks for watching, and we'll see you in our next video.